Okay, buying something big overseas, you got to worry about exchange rates. Let's break down how to lock one in.
So, let's say you've found it, that perfect dream home, maybe somewhere in Spain. Amazing.
You agree on a price, say 250,000 euros, but the payment isn't due for a couple of months.
And in those 2 months, well, exchange rates can go crazy. A sudden jump could cost you thousands.
So how do you avoid that? Enter currency futures. Think of it as a binding promise on a price.
For that home, you'd buy a couple of futures contracts. And just like that, you've locked in your rate.
Now let's look at the outcome. If the euro gets way more expensive, you've just saved yourself 30 grand. Nice.
But what if the euro's value drops? You're still stuck paying that higher price you locked in.
So with futures, you get certainty, but the trade-off is that they're totally inflexible. It's a binding deal.
But what if you want flexibility? Well then, you look at currency options. They're like an insurance policy.
And just like insurance, you have to pay for it. That upfront cost is called the premium. Okay, so how does this work out? If the euro price jumps, you just use your option. Simple.
But if the euro gets cheaper, you just let the option expire and buy at the new, lower price.
And that's the key difference. Instead of losing 20 grand, you're only out your initial premium.
Okay, there's a third tool, mostly for big institutions. Forwards. Think of them like a custom-tailored suit.
They're super customizable, but they're not traded on an exchange. That means there's a risk the other party could back out. So let's recap. Futures are a binding obligation. Options are a flexible choice. Forwards are totally custom.
See, it's not about which tool is the best. It's about figuring out which trade-off is right for you.
So for your dream home, what's it going to be? Absolute certainty or a little bit of flexibility?